morning, everybody. Thank you for joining us for the first of our three-part series looking at managing the risk of your health insurance and related employee benefits. Today, I'm very pleased to introduce to you our presenter. His name is Roger Bain, and he is with Benefits Indemnity Corporation. And we've enjoyed a lengthy partnership with Roger. And he has a great technology platform that can help you in understanding the risk associated with the usage among your employees' medical benefits. Today, in particular, he will be talking with you about a unique approach that will help you solve some of the problems that we see created by the Affordable Care Act. So again, thank you for joining us today, and we hope you find this information to be very useful. And at this point, I will turn it over for some housekeeping items with Janet, and then we'll get started.
Okay, just a few housekeeping items. If you have any questions, please type your question in the question box on your screen and press send, and we will answer the questions at the end of the webinar. Also, within the next few business days, we will send you a copy of the PowerPoint presentation, the webinar replay, and the answers to any questions that are asked. Okay, so now we would like to turn the presentation over to Roger.
Good morning, everyone. Thank you for coming, and it's welcome. Pleasure to be here. Appreciate your time and attendance this morning. Just going to make sure that I have control here of the slides, and there we go. So obviously we had a lot of groups represented here, and JRG likes to thank all of you for being here, so we much appreciate that. Today we're going to talk a little bit about the BIC self-funded marketplace and our exchange, but really what we're talking about is a unique approach in trying to determine whether or not the ACA has truly been beneficial to your group or not, because many of us feel that the ACA has been damaging, others feel it has been life-saving, and every group is unique in that respect, and yet oftentimes blind to whether or not their group has really gotten the assistance they needed from the ACA or whether it's been more challenging. So rather than flying blind and talking about what we're looking at, one of the things we know is that after the ACA, deductibles are higher than they have ever been in this country before. So employee cost sharing is at a higher level, causing a certain level of frustrations and difficulties within the employee population. Even more frustrating is that employers are paying higher premiums for those higher deductibles. So our price escalation continues to skyrocket while our deductibles and cost sharing continue to go higher, and it doesn't appear to be a whole lot of effect in providing better benefits that we were hoping for. Compliance costs as a result of the ACA have become higher, reporting has become burdensome, and that's a challenge. And the rate rationale for your group is really completely lost to the rules and the regulations of the community rating as per ACA. And it's not even real community rating anymore. It's community rating compounded by a couple of risk adjustment mechanisms that are created in the ACA behind the scenes that make your insurance carrier juggle their premium, and that those that lose money have to send, or those that make too much money have to send money back to the government, and the government shifts that money over to someone else. So there's a total loss of predictability for the insurance carriers, and you pay the price for that because that means they just raise their rates to cover contingencies that they may have never had before. You've probably seen a number of carriers withdraw from your marketplace. Aetna has withdrawn from our marketplace here in the Maryland area and in many states, probably in Pennsylvania as well. And their rationale is that they had to pay $30 million to their competitors just because of ACA rules in the block of business that they've built. And that's a second year in a row where they've had over $30 million in payments to the government that are just funneled back to the competitors and make it impossible for them to try and run their business within. So we have that loss of rate rationale, and then we have a total loss of transparency. Nobody really knows where all their money is going. And you as customers, if you're not frustrated, you certainly should be. And the only thing I ask of you is if you are frustrated, give us a little sympathy, because I've been doing this for 30 years, and believe me, I understand what that frustration can be like. So employee benefits were really built as an incentive and to help recruit and hire and retain the best employee population. Better benefits than employees find on their own, if you can't do that, then providing benefits really becomes just a commonplace thing. One of the things we used to have is more precise and specific rating for your group. Now, from a position of healthcare reform, to be honest, that specific rating for your group was an opening that in many years ago, back in the late 80s and early 90s, became a real problem where carriers would actually game that and take groups that had sick conditions, raise the rates, and drive them out of the market so they didn't have to pay the claims. That, while isolated, was significant enough to create the need for healthcare reform over the last 30 years that brought us to the ACA on an extreme compounded level. So there's a balance here. Integrity and ethics, along with precise and specific rating for your group, is important. So that's what we're seeking as we continue to develop healthcare rationale to develop better regulations for you and for your groups to provide stronger benefits overall without those problems. Clearly, we want to achieve lower deductibles and lower out-of-pocket costs for the employees, because offering an employee that makes $40,000 a year a plan that has a $12,000 deductible for the family just doesn't seem to make much sense. So we have to look at how to get those lower out-of-pocket costs for the employee populations. So we've got to reclaim the best parts of the health insurance business without the bad parts. So how do we achieve that? We want to get better benefits. We want to get transparency so we know where our money is going, and we want to get the appropriate rates. Nobody's saying we don't want to pay the fair price, but all of us want to pay what the appropriate price is, and that's the most important thing. From there, we can achieve some savings and develop some other way to do it. Self-funding is one of the solutions that helps us do that, but it's a very threatening word or phrase. Most people are afraid of that. Self-funding, I will tell you right now, is where 65% of all American employees are. They're covered under a self-funded plan. The plan is typically covered with lots of insurance in the small group arena. And so the fears that we have about self-funding really need to go away. The key difference between self-funding and fully insured benefits is simple. It's not about risk, and it's not about not having insurance, and it's not just for the large groups. It's for everybody, but let's just clear up a few basic questions. In a fully insured group, what your group is doing is collecting money from employees and your own contribution, and you're paying that money over to an insurance company. And then that insurance company makes the promise to pay benefits to the employee, and it's that simple. So really the benefits, the promise to pay, is made between the insurance company and the employee. And it's pretty clean and pretty straightforward from that perspective. But the employer has no real obligation to pay any claims. In a self-funded plan, it's a little bit differently. The employer makes the promise to pay benefits to the employees, but then purchases administrative services and insurance to protect them from that whole exposure. So we're not suggesting that employers get into the health insurance business and start running their own health plans. We just suggest they start owning their own health plans. And that's really the key difference. Have the employer promise to pay benefits to the employees, and you remove yourself from a significant portion of the rules under the ACA. And that removal gives you certain advantages, and that's what we're going to talk about today. No one should look at digging into taking those advantages without knowing what they have in a group composite. So let's take a look in those two differences. There's plenty of insurance in each one of these plans, but let's find out which one makes sense for your group. And the only way to do that is to do a group risk analysis and to really take a look at your group population. Way too many employers are paying way too much for their coverage. Many employers deserve far better, and when I say many, I'm talking about as many as half of you are paying way too much than you should be. In fact, 70% of American groups pay more for health insurance premium than they get back in benefit claims for their employee population. And that's a bad place to be. So let's find out if you're one of those, and let's determine a course of action. And the way to do that is look at what happens. Insurance by nature, the good subsidize the bad. That's what goes on. Low risk subsidize high risk. And that's perfectly fine, perfectly normal. It's exactly what we want to happen, as long as we know that it's done in the right balance and that there's not an over-aggressive move towards shifting those costs. So lower utilizers are going to subsidize higher utilizers, but recent regulation have taken that to an extreme under the ACA. So you could be subsidizing your neighbor or even your competition at a higher level now than you ever have been before, taking basic insurance principles to an extreme that just makes it too heavy in subsidizing your competition. So some employers are very conscientious about the health and the welfare of their employees. Others are simply not. And there is a difference in that, and that's why we have to know. How much are you paying for them? We don't know. Until now, it's been impossible to tell. Insurance companies in the small group arena are hiding what you spend. You don't get claims experience, you don't get reports, you get a big renewal increase, and they give you no information in the small group arena as to why. In the large group markets, they have to give you experience. The market demands that they give you claims runs, they give you an idea of where your money's going so that you can make educated decisions. In small group, they don't think we're good enough to do that. So we're going to change that, and we're going to stop hiding what's going on, and we're going to look at those regulations that set your rates for insurance, or we're going to remove ourselves from them by going through a group risk analysis. And that group risk analysis will dig deep within your group, find the answers to many questions about your group status, and by unlocking that power of knowledge, you get the opportunity to really find out, does your group deserve better? How much might I be paying to other groups? Why is my group better? Or why is my group worse? If my group isn't better, I certainly want to know that before I take any strategies for a long-term benefit plan. So how can I use the results of this analysis? Well, let's talk about that for a minute. There's several ways to calculate a rate and determine what a group should be paying. You've got group demographics, you've got an industry trend, you've got the cost of your location, i.e. what your cost of living and medical expenses are in your area, utilization of your group, how much health care they use, the body mass index of your group overall, smoking status of your group. All of these things have an effect, including the health of the people within your group. All of these have an effect on your health plan rates or costs. Oftentimes under the ACA, they don't affect your rates because you're rated just like the next guy, no matter how good you are or how bad you are. So in the real world, we like to move back to finding actionable items. Let's execute better options that might exist. Engage some long-term strategies for saving, provide more satisfied employees, improve benefits and costs, and when we find groups that really are challenged and have high risks, let's work to rehabilitate those groups. Through our group risk analysis, we will learn more about your group than you've ever learned before, and you'll be able to take that information and develop wellness initiatives, educational programs, and in fact, JRG will help you develop the wellness programs to take groups that have challenges and help make them better for future years so that down the road you can qualify for preferred rates and get something really the nice way. The old ways, we would have a broker shop everything. We get a big spreadsheet of rates and benefits. We pick one as we're getting close to our renewal deadlines. We have meetings with employees. We go present everything. We address all the grievances of the employee population. Why are you changing my deductible? Why do I have to pay more for my drugs, etc.? But yet we have no idea and no information to give the employees. So we only calm the employee population with a promise to do our very best, and that's all we have. Blame the problem on the insurance companies, blame the problem on Obamacare, blame the problem somewhere, but just try and keep things moving so that we can get through this dreaded renewal process every year and move on. So we have employees complete tons of paperwork. We rush through a plan selection in time to submit. We get there before the deadline. We calculate final enrollment after everybody makes up their minds. Then we get what the real rate really is, and it comes back. And if they're still happy, we get to move forward another year. And we hope we get our ID cards in time, we get temporary information in place. But if not, we have to start over and shop everything, or complete more paperwork, or even stay where you are, accept your renewal increase, pass on the cost of the employee populations. And that has been a trend for my 30 years in this business. We've seen that so many times, and way too many times, and it's not necessary. With today's technology, it's crazy to go back to the old way. In the new way, we get enrollment done early, 90 days before you're even considering making your change or renewing your health plan or looking at something new. You get the employee population to enroll. You use electronic enrollment instead of paper, and we'll get to why that's so valuable. Get them on the computer, even if you have to set up a cubby in your own office because they don't have computers. Bring them in, sit them down, coach them through the process, or you'll find most of them know how to do it anyway because they've done plenty of things. Anybody that's bought anything online knows how to go online and purchase or enroll in health plans. So it's a lot easier than people think. But using that electronic enrollment for your group lends you outrageous advantages and value. Then you get a group risk analysis as well. From the information that we garner by doing the online interview for your employee population, we can improve strategies based on the knowledge gained well in advance of your renewal. We can scour multiple markets to find the very best benefit strategy for your group. We can review proposals now from those that fit you best, taking a market of 6 or 7 carriers that offer 100 plans each, and maybe expand that market to 6 or 7 self-funded carriers and boil it down to the 2 or 3 top finalists with the rationale as to why they should be the winner, making the whole job easier and more complete. Then we communicate those final plans to the employees. Here's your choices, plan A, B, or C. Take your pick. Let's go out and do that communication through group meetings, an online portal, webinars like this one, or any combination of those things. But the message then is always good news, because either we've improved the plan or we know why not, and we have a plan to go after that for future years. And you can assure your employees for once that we're actually taking a benefit strategy instead of just taking a purchase that the insurance companies are sliding on the table without any choice. Now we can move forward and take that strategy in the new way. And we have all of our ducks in a row. We receive an employee plan selection electronically, complete the final group paperwork well in advance of deadlines. We can provide and distribute final plan materials on time for a change, and it works out better for everybody. So the goal here is to streamline the process for you as an employer. We reduce the paperwork, we reduce the handling, we improve the communication, we improve employee satisfaction as well as employer satisfaction, and we save you money. In 30 years in the insurance business, the one thing that I've heard from employers all the time is you have to keep my employees happy and you have to do it for less. Well, that's the goal, that's the mission, and that's what we're working to do. And whether it happens this year or next year or 2 years down the road, working through this process is the mission to get there. So electronic electronic enrollment will enhance the application accuracy and save you a lot of time. In fact, most of the employers that we work with ask us for a spreadsheet of the employee data because it's more up to date than what they have in their payroll records. So that's an important thing. Applications we get are all completed at the beginning, so we're in great shape. Enrolling for other benefits like dental or life insurance, etc., it's very easy to do that online, and keeping that data helps you at the renewal time next year, where it's a simple update. Instead of filling out a whole new paper form, starting over again, it's simply go into your portal, log in, make your changes, and you're off to the races. So what we want to do is work with that portal to enroll and collect the demographic and utilization data for analysis. Then we can establish an educated long-term strategic benefit plan, and JRG will be delivering that as we scour the entire market with the power of knowledge, implement the best strategy for rates, benefits, and features. You can present that then to the individuals, your employee population, through an online marketplace, along with whatever other communications you choose. They can pick their desired benefits, whether they want plan A, B, or C, and we can move forward. So the real value of this group analysis is we're going to get results that help us learn about your location in your industry, your utilization, your health status of your group, your body mass index, smoking, your prescription drug utilization, any existing medical concerns of any significant risk, and the demographics of your group, all combined. By combining those, we have the opportunity to make a difference in what we're doing in our strategy for healthcare. Now, I'm going to pause for 1 second, only because my slides seem to have paused. We're having slight technical difficulty. Janet, if you're out there and you can help me out here. Here we go. So the data that we get provides actionable intelligence. The knowledge provides you more power to make better decisions. The benefit indemnity team will analyze your enrollment data, establish parameters as to exactly what we're looking about. We'll work with JRG in collaboration to make the right recommendations, suggest the appropriate strategies for your group, and then of course JRG will present that to you where you can make your final decisions and then communicate the plan to the employee population. And then we use the electronic data that we've collected to map that data from your employees to virtually anyone's enrollment form. So if the carrier is going to require you certain forms or a certain health plan wants certain forms, it doesn't matter. We don't have to go back and fill out new paperwork now because we've collected the data digitally. And in this modern age, to fill out a paper application once we have that information is absurd. So we will have an electronic signature we can map to multiple carriers' applications, and we can move that data to whoever's application we need to. And from there, we're off to the races. So it simplifies everything by using electronic data and electronic signatures. We're able to get you new places. So our self-funded exchange marketplace will help you save time and money by collecting, analyzing, strategizing, planning, and then easily executing your plan on a whole new light from a position of knowledge instead of a position of helplessness. And that's really the objective that we're trying to get. Now, at this point, I think we can certainly open up for questions. I know I went through that pretty quickly, so if there are questions, I would love to address them. And then I'm sure that Janet or Jesse may want to make some comments about the next webinars and any other upcoming things. Thank you, folks.
Thank you, Roger. This is Janet again. If you have a question, please type it in the questions box on your screen and press send, and we will answer your question. Also, I wanted to remind everyone about our next webinar. It's actually part of the special 3-part series regarding health insurance cost reduction strategy. The webinar will be held on Thursday, August 10th at 10 a.m. regarding employee contribution strategy. And then our third webinar is Thursday, September 14th at 10 a.m. regarding healthcare cost transparency. I will start with our question. Our first question is, how many employees do I need to participate in the analysis and potentially self-fund?
Well, it's a very good question. Thank you. We have our specialty in this group risk analysis is for groups of 5 to 150 employees. So as low as 5 employees enrolled in a health plan, or as many as 150 enrolled in the health plan. And once we get over 100, frankly, we'll probably look at a couple of different ways to do it. But when we're down between 5 and 100, we've got multiple options, but really one methodology, and that's the online group risk analysis.
The next question, how long does the analysis process take, and should I start when I get my current fully insured plan renewal or sooner?
Well, the process takes no longer and most often a lot less than paper application process. I've had groups wrap this up in 1 week, and I've had other groups that take 60 days. So it really depends on the diligence and the personality of the employee population and the leadership. If we drive it out to a group, it should be completed as fast or faster than paper. And once it's completed, everything else after that is faster than the paper process because nobody has to go back and scrub applications to find missing Social Security numbers or other missing information that is inevitable when we use the paper process. So it should take probably, I'd say, 2 to 3 weeks is what a standard look should be. And I would say by all means, never wait until your renewal. I would like much better to have a full strategy built in time for your renewal so that you really can make that decision more quickly at the time of your renewal and move forward. So 90 days out is a great starting point. You should have your renewal somewhere between 45 and 60, but if we start 90 days out, you may know exactly where you stand the day you get your renewal. You might know the rest of your options as well, so it can be very effective.
Okay, the next question. Is the information you get from my employees confidential? I don't really want to know the specific issues of each employee or dependent.
Yes, that is absolutely true. All of the information will be collected in a high security portal with securities comparable to or better than the banks. So all of that information is protected there. The reports that you get are completely generic. There are no named things there. As an employer, you have a right to it if you want it, but most employers, or at least the majority of employers, really don't care to look at the individual specifics, but that group analysis where they look at the overall picture is very valuable.
The next question is very similar. They're asking, how does HIPAA affect the information exchange in the digital application process?
That's a question we hear all the time because people think that HIPAA means you're not allowed to ask employees things, and really it's not true. What we have with HIPAA concerns are that it is illegal for an employer to misuse any information they collect. It is not illegal for them to collect it. In fact, as an example, in order to do payroll, you have to have employee Social Security numbers, and that is called protected health information under the Act. So you're required to have it, you're just not allowed to misuse it. So employers that want to look at a deep dive analysis of the claims and the information in their group, they have a right to do so. They just have no right to misuse that information. So HIPAA is not a concern unless you had an employer that wanted to act in some unethical manner.
The next question, if my renewal is January 1st, 2018, should I have JRG work with me now to get the analysis results?
My answer to that would be yes. If you're January 1, you want to be started at that 90-day mark. So you can kind of lay out the procedure, and you want the first applications to start no sooner than October 1. 90 days is really kind of a magic mark where carriers are not going to accept the information if it's older than that, but anything from 90 days into the effective date is ideal.
The next question, can I still have an FSA and or HSA plan with a self-funded plan?
And the answer to that is absolutely. HRAs and FSAs, those types of features are completely available, whether using self-funded or fully insured. In fact, many times they complement a self-funded plan even better than they might a fully insured plan.
The next question, does the JRG, ERISA, and ACA compliance services work with self-insured health plans?
I would imagine so, but that one I think I'd have to let JRG answer. It really should not be a significant difference from JRG's perspective, so my answer would be yes, but I'd have to have JRG confirm that.
Okay. Yes, it does.
Good.
Okay, I think that's the end of the questions. And I wanted to thank everybody for joining our webinar today. And hopefully you'll be able to participate in our next webinars as well. And I want to thank Roger for being the presenter. You did an awesome job, Roger.
Thank you.
And we will, as I said in the beginning, we will send everyone a copy of the PowerPoint presentation, webinar replay, and the Q&A from today's session. Thank you and have a great day.
Thanks, everyone.